There were significant policy failings at that time. Put them in two categories. At that time, and it's quite hard to remember, but there was a huge difference between the Conservative Party and the Labour Party in terms of its policies. I mean, Labour was overtly socialist. And so when you had a change of government, you had big changes of policy. Probably most relevantly here was on the supply side, with Labour had restricted the supply of offices, and then through office development permits, and that was then changed completely by the Tories, and so supply was unleashed. The other one, I think most important, was the government's economic policies at that time. There was a real dash for growth, and the Chancellor even set a target of 5% GDP growth. And really, the taps were left off, and really that government had forgotten the lessons of the 1920s and 30s. To me then, it really pointed out the problem with lending, that the basic problem that if a lender wants to build up their business, increase their market share, they do it by dropping their lending standards, so they're taking more risk. So ultimately, the thing is likely to go wrong, which of course is what we saw in 2007, but there was evidence of it in 73-4. And the other point, I think, is how real estate people look at debt. If you're borrowing, the loan to value on the loan is more than 70%, there is some chance the lender won't get their money back in its entirety. And if you increase that leverage level, in a way, for the risk, there's real asymmetry in the risks. As far as the borrower is concerned, their potential return on the upside is unlimited, but if it all goes wrong, they simply lose their equity. For the bank, all they can get is, if it goes well, they get their principal back and interest, but of course if it goes wrong, they may have a very large loss. So there's that real asymmetry. And I think Martin Wolf, the well-known FT economist, in his book on the global financial crisis, has emphasized that really credit markets are innately unstable. And 73-4 was clear evidence of that. Well, I think while the policy side was complicated, and then the oil shock, which really tipped the economy, well, the global economy down in the UK with it, was a genuine black swan event. It was the first time in post-war real estate when you'd seen what happens with too much leverage and too much development. And then, but in a sense, what did we learn? Well, that's rather more debatable, because of course we've done it twice since. So I have to say, we didn't learn as much as we should. Well, I think certainly 73-4 to me was more like the global financial crisis than the other downturn of the late 80s and early 90s. I don't see us having another crash in this decade, because people's memory is too strong. Everyone remembers very well what happened from the global financial crisis. And so we're not going to get the over-exuberance which usually produces a bust. The real question for me is, how long does that memory last? And the real test will be actually in the next decade, where previously we've had a crash every 15 to 20 years, so we would expect it to be in the next decade. Will memories have faded as they have in the past, so we do have another one, or will this have been so catastrophic that we won't make that same mistake again?
you.